So we titled our 2025 outlook The Dawn of a New Cycle. And so we're expecting the 10 to 15% total return for US listed real estate in 2025. What's driving that? It's accelerating year over year earnings growth. Nothing meaningful, but going in the right direction. We're assuming about 4% growth this year in 2025 versus about 3% last year in 2024. We're assuming lower supply deliveries. That really should take place in 2025 and into 2026, potentially into 2027, depending what happens in the construction pipeline. But we think supply is coming down.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. In this episode, I'm joined by three members of the Citi Global Research Team to hear their thoughts on regional outlooks and sector performance. My guests are Nick Joseph in the US, Aragai in the UK, and Howard Penny in Australia. So welcome to all three of you.
Thank you for having us, Sarah.
And Nick, let me start with you. What are Citi's expectations for global macro fundamentals this year, and how are they impacting your commercial real estate weightings on a geographic basis?
Absolutely. It's a great question. So, from the macro side, Citi's global chief economist, Nathan Sheets, is broadly optimistic. He thinks that growth looks set for another near trend performance, and declining inflation should allow central bank cutting cycles to proceed. And so, just to quantify that, it's about 2.2% global real GDP growth. That's 1% in the US, 1.1% in the euro area, and 4.2% in China. Then, of course, the second broad storyline involves what happens coming out of the November elections and Donald Trump's victory. In the baseline Trump scenario, it includes tariff hikes, extension of the 2017 tax cuts, immigration changes, broad deregulation of Biden-era requirements, and then some boosts to the broader market in animal spirits. And so to your question, how this plays into our regional views of local listed property markets, when I look across all of our analyst views, Citi is most positive on the US, Australia, Europe, Philippines, and Indonesia. We're a bit more cautious on China, LATAM, India, Japan, Singapore, Hong Kong, and Thailand.
Right. And what are some of the most consistent commercial real estate investment trends you're seeing across geographies?
Yeah, so clearly macro interest rates, geopolitical sentiment, it's all mixed globally. So when I look at it, stock preferences are really heavily driven by our regional team's micro analysis. So the sectors themselves are actually not globally consistent, which really does show that supply and demand drivers from each individual region. But nonetheless, in the US, there's a preference towards residential, healthcare, industrial, and towers. APAC most preferred were diversified companies, retail and shopping centers, residential, industrial, and data centers. Europe and LATAM preferred resi, shopping centers, and development. And if I look on the other side, the office sector was the least preferred in the US and the Europe and UK. In APAC, it was spread across retail and shopping centers, resi, office, hotel, and development focused companies. And then if I kind of group it all based off of themes, the most preferred was really driven by strong rental growth assumptions, and the least were driven by weak growth assumptions and elevated valuations. And one interesting thing we found is that from a leverage perspective, higher leverage was less concerning as a justification for least preferred stocks going into 2025 versus what we saw a year ago. We think that probably indicates that people are more comfortable with the current cycle and the declining interest rate view. And so it's a little less of a concern in 2025 than it was last year.
And Citi is expecting US REIT returns to increase 10 to 15% this year. What are some of the main reasons behind that forecast?
That's exactly right. So we titled our 2025 outlook The Dawn of a New Cycle. And so we're expecting, as you said, 10 to 15% total return for US listed real estate in 2025. What's driving that? It's accelerating year over year earnings growth. Nothing meaningful, but going in the right direction. We're assuming about 4% growth this year in 2025 versus about 3% last year in 2024. We're assuming lower supply deliveries. That really should take place in 2025 and into 2026, potentially into 2027, depending what happens in the construction pipeline. But we think supply is coming down. A solid macroeconomic background, which we touched on earlier, and then reasonable valuations. How do we get to that 10 to 15%? As I said, 4% earnings growth, and it's about 4% dividend yield. So all else equal, that gets you to about 8% if multiples or cap rates don't move. And just a reminder, one multiple turn or 25 basis points cap rate compression is about 6% for a stock impact. And so to get to that upper end of 15%, we're assuming multiples expand by about one turn. The earnings growth, that 4%, is really driven by stabilizing operating results, acquisition, development, and redevelopment benefits, and then the retention of free cash flow. I'd also say that some sectors and companies have the green light for external growth, so that could be an additional driver of earnings growth this year. Within our model portfolio, we're overweight residential, healthcare, and that's really a preference for senior housing and skilled nursing, and industrial. And right now, we're underweight larger net lease names, the self storage sector, and the office sector.
And are you seeing any change in sentiment in the commercial real estate sector in relation to the new US administration?
It certainly changes by the day, but it's definitely very topical. I think coming into the year and post-election, there was an expectation that the US would see higher growth than maybe what was expected before. But of course, that comes with potentially higher rates and potentially higher inflation. And so there's push and pulls there. The two main topics that we've been writing about would be immigration. And obviously, what ultimately happens is unknown, but we're thinking about the potential impacts to housing and the potential impacts to the labor market. And two of the sectors that we've talked about in the past would be hotels and senior housing and the impact there. I'd also throw in cold storage. And then finally, of course, tariffs, which have been very topical recently and this weekend. And the two sectors that we're keeping an eye on from that perspective would be industrial, what happens with global trade, and then, of course, retail, what happens for the US consumer.
And turning to Howard, what's the interest rate cycle looking like in Australia for 2025? And what does it mean for commercial real estate stocks this year?
Thank you very much. Trade uncertainty, of course, is driving a key global theme in 2025. However, down here in Australia, fortune will likely be dictated by domestic economic factors, we believe. And in 2025, we're still seeing real GDP growth rebounding. And this is predominantly driven by population growth through immigration as a long-term driver of growth. And inflation itself is also coming back to around the 2 to 3% target band. And that is thanks to a deceleration in housing and service costs. And so this outlook is resulting in a less hiking environment. And our economists are actually expecting the commencement of interest rate cuts starting as early as February with a 25 basis point cut, followed by potentially another two later in the year in August and November. And so we're expecting this decrease in interest rate environment to provide a more supportive valuation environment for our real estate stocks. And the quantitative studies that we've done have indicated that between 0 and 4 months before the start of an interest rate cutting cycle here in Australia, we have seen real estate stocks outperforming general equities, and sometimes for 2 to 3 years after the first cut. And more specifically on the subsectors that are highest beta to this include our fund managers, which are very prevalent here in the Australian market with a high beta towards these interest rate changes, as well as sectors like retail and industrial, which are also supported in this environment. And so therefore we remain fairly optimistic at this point as we're just getting to the end of the peak interest rates down here in Australia. And perhaps this lower inflation will start to drive some optimism in our sector and hopefully some outperformance.
What do you think that could mean in terms of transaction activity in Australia this year? And are certain sectors more likely to be making deals than others?
Thank you. Absolutely. We are expecting that backdrop of lower interest rates and declining interest rates to provide also a more supportive environment for physical transaction activity. The stabilizing interest rates and bond yields are also stabilizing our expectations on cap rate. And although we do see some potential weakness in the upcoming results season this month, we do believe we're getting to the bottom in valuations, and therefore that supportive environment will start to attract capital from around the world, but most notably and probably across Asia Pacific. And therefore, this increased demand, we're expecting to be focused around retail, where we see supportive fundamentals, where occupancy is being supported by limited supply and strong demand. And the growing population and growth that we're seeing in the economy continues to fuel a like-for-like growth in the demand for that asset class. We also see the potential for some selective interest in value office opportunities and we're starting to see a few transactions there. And we're also expecting continued investment in the more popular historic industries over the last few years, namely industrial and more recently the data center environment. And so overall, we're expecting a potential increase in transactions of up to 10% year on year from 2024. And this should place transactions potentially at just under 50 billion Aussie dollars over here.
Aaron, turning to you, to what extent is low economic growth in Europe and the UK impacting the commercial real estate there?
Yeah, look, in Europe, for us, it's about the direction of rental growth from here. Yeah, real estate returns are mostly driven by rental growth, and rental growth has been relatively negative for various reasons over the last sort of 5 to 10 years, including the low economic growth that you mentioned. So real estate stocks have declined at different stages at different times, but generally most sectors have seen a downward repricing in nominal, but particularly in real terms. But rental prospects from here, for us, have kind of two broad elements. You've got the economic cycle, including the sort of structural changes we're seeing in various sectors, which is somewhat predictable and looking to be a little bit more positive. And then the less sort of predictable elements, geopolitical, other factors like tariffs, wars, external shocks, things like that. Given the UK and particularly Western Europe as well is struggling for sort of economic growth, and with rates a stimulus card that can be used after a prolonged and disjointed down cycle, we think rental growth combined with cost control that we're seeing in the market as well, easing of cost inflation, interest rates improving for borrowing costs and comparable investments. It's also combining to sort of improve earnings growth outlooks that are increasingly positive in the UK and Europe. So we've been generally upgrading estimates and recommendations over the last year, various reasons, and numerous years before that, we had to go through a phase of downgrades. So in Europe, where despite the low economic growth, we think it's going to be increasingly positive from this sort of point, and we're generally increasingly and gradually positive on the UK and European sector, which is a nice change.
And where would you say the greatest opportunity for commercial real estate growth in Europe and the UK is probably going to be this year?
In terms of sort of sectors, we think there's opportunity in residential sectors, logistics, including sort of the data centers, that element as well, healthcare, self-storage, West End diversified names, some shopping centers as well, where there's a recovery sort of going on, where there's clear catalysts that we can see are visible. As I mentioned, increasingly earnings estimates are turning positive after quite a number of years of headwinds. The other factor that we're also positive on is dividends. Combined with that earnings headwind, we had dividend headwinds, and we've just come through a quite a long extended period of dividend headwinds, of cuts in some cases, and just lack of growth. And we think with the emergence of cyclical confidence and earnings growth, that there's quite a few stocks out there which have quite attractive dividend growth prospects. So those sort of fundamentals, combined with some of the recovery elements in the dividend, are playing into a number of stocks where we think that the PE valuations have scope to increase as cyclical confidence builds. So those would be the sort of areas that we would focus on here in Europe.
Excellent. Nick, Howard, Aaron, thank you so much for giving us that great overview.
Absolutely. Thank you for having us.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe on your favorite podcast platform.